Welcome to Ideas of India, a podcast where we examine academic ideas that can propel India forward. My name is Shruti Rajagopalan, and this is the 2025 Job Market series where I speak with young scholars entering the academic job market about their latest research on India. Our fifth scholar in the series is Karthik Narayan, who is a doctoral candidate in economics at Nuffield College and at the Department of Economics at University of Oxford. His research focuses on monetary policy, macroeconomics, and finance in developing countries. We spoke about his job market paper titled Macroeconomic Effects of Scheduled and Unscheduled Monetary Policy Surprises. We talked about how the Reserve Bank of India makes and announces its policies, its impact on interest rates, inflation expectations and output, measuring the impact of policy announcements, the Lucas critique, and much more. For a full transcript of this conversation, including helpful links of all the references mentioned, click the link in the show notes or visit mercatus.org/podcasts. Hi, Karthik. Welcome to the show. It's a pleasure to have you here.
Thank you very much, Shruti. It's a great pleasure to be on your podcast. I've been a great fan of it, and so I'm especially happy to be on it as a result.
Yeah, I was telling you just before we started recording that the job market series we do with young scholars is my favorite part of the year because I get to read so many new cool papers, and yours is one of them. So you sort of look at something that we are all very obsessed with in both good times and bad times, in the sense of watching what the central bank and the central banker does and how it's going to impact the broader economy, right? More specifically, you sort of look at how financial markets react to a policy change from the central bank. And the way you are looking at it is you separate when it is expected, that is, when it's a scheduled announcement, versus when it's sort of a sudden or unscheduled announcement in terms of the central bank reacting to, what's happening more broadly in the economy or in global markets. And what you show is that the scheduled rate decisions behave in line very much with what theory would predict, right? Tighter policy is going to depress stock prices. It's going to slow down or decelerate growth. It reduces inflation over a longer period of time. But unscheduled decisions, they don't look quite the same as this exogenous policy shock that we think about, right? And your explanation is that they often happen alongside other news. Markets are reacting to two kinds of signals, both what's happening in the rest of the world and what the central bank is reacting to, and what the central bank also announces. And the broader takeaway, I guess, is more methodological. That is, if you really want to think about or measure the true power of monetary policy and monetary policy transmission through the rest of the economy, it's better to look at scheduled moves rather than unscheduled moves. So first up, did I get your very detailed paper largely correct? And second, can you tell us more about it now?
Thank you very much for that excellent summary of the paper. I would say you are getting exactly what I'm trying to convey as a sort of implication and a takeaway for other economists working on measuring monetary policy, not just in India, but also in other emerging markets, where measurement of the effects of monetary policy is, continues to remain a challenge, even as people are trying to, do a lot of work in trying to measure that more accurately. But I just wanted to sort of take a step back and provide some broader context and motivation for what I'm trying to do in the paper. So, we see central banks all around us all the time, reviewing and altering monetary policy. And if you read the financial press, there is just a lot of commentary around this all of the time. But surprisingly, it's extremely difficult to find rigorous estimates of the causal effects of the central bank's policies, and particularly its monetary policy, and how that's affecting the economy. There have been a lot of papers that have been written, particularly in advanced economies, trying to make a lot of headway in this direction. But if you just open up any issue of, the American Economic Journal in macroeconomics or Journal of Monetary Economics, you will find that there continue to remain debates among economists about whether we're measuring the causal effects of monetary policy correctly, even in a data-rich environment like the US. The problem is just much more in developing countries where, you don't quite have the same granularity of data available at the same frequency or for the same time periods. And sort of the fundamental problem here is that a central bank is trying to set policy in as systematic a manner as possible in response to what is happening in the economy. As a result of this, for an econometrician interested in cause and effect, it's very difficult to learn anything meaningful from regressing central bank interest rates on outcomes of interest like output or inflation, because the central bank is at some level reacting to both present, past, and expected future economic conditions. And so if you're going to do this regression, it's very difficult to get a causal effect of the central bank's monetary policies on the economy. But of course, this number is very important for a number of reasons, most particularly for policymakers themselves, because it's important for them to know the magnitudes or the quantitative effects that their actions are having on the economy in order to arrive at a reasoned judgment about how they should be reacting to any incoming macroeconomic event. What I try and do in this paper is to make progress on measuring monetary policy and its effects on the macroeconomy in India. If you look at the past literature on this subject in India, the consensus is that it's very difficult to find empirically effects that are economically meaningful and theoretically in the expected direction on aggregate demand in India. Monetary policy, the academic consensus in the empirical literature is that it doesn't have very significant effects on aggregate demand. Now, there are two competing explanations for this. Some people argue that, in India and in other developing countries, monetary policy transmission is weak for a number of structural reasons, including the fact that, the fiscal authority isn't necessarily behaving in a fiscally sustainable way in terms of the public debt. And so when interest rates rise and there is no debt sustainability practice in place, and so markets expect these higher interest rates to actually be serviced by higher inflation in the future. And so even if central banks are raising interest rates, people don't, lower prices because they don't trust the government's commitment towards inflation targeting and keeping inflation under control. But there's the other view which suggests that maybe we need to think more carefully, empirically about the data that we're using to identify the causal effects of monetary policy before arriving at a decision, in our minds about whether or not monetary policy is effective in the sense that we think about it in a macroeconomic model, in that, higher interest rates help to lower inflation and reduce the output gap and help sort of stabilize the economy when it's overheating. So I provide evidence in favor of the second explanation. So one thing I want to say here for context is that given the empirical challenge that I've laid out, which is the central banks act systematically, and so it's very difficult for econometricians looking at the data to identify the causal effects of any change in interest rates on macroeconomic outcomes of interest, what the monetary economics literature has converged on as a way around this is to try and identify changes in interest rates that were unanticipated by the market, and to use these, what are called monetary policy surprises, to estimate the effects of central bank policies on the economy.
So, Karthik, what you're saying is super important. And the reason I think it's important is in between all of this, market response and people respond, what we forget is in times of crisis, like recently we've had COVID, or the current shock when it comes to tariffs and things like that. We've had before that, we've had the global financial crisis. What we expect is that the government has some policy levers or interventions that it can make to actually smooth out some of these disturbances or shocks that people are feeling, right? A big part of that is monetary policy, which means that the central bank is going to use the biggest tool it has, which is, figuring out the interest rate for the money supply. And through that, send a signal into the economy on how everything else will follow. And because people are not pieces, chess pieces on a board, and they're actually rational and they have expectations, they react to some of these signals. And the way they're going to react to a particular rate set, whether it's an increase or a decrease in interest rates, is very hard to predict. And the reason sometimes it's hard to predict, for the regular readers is sometimes that information is already included because of what's going on in the market. Sometimes, it leaks. People are like, oh, there's this, MPC is going to meet tomorrow and they're definitely going to go do a rate cut. There are Satta markets in India which are betting on how big the rate cut will be and things like that. So sometimes this information is already absorbed and that's why you don't see a big reaction. And sometimes it's not absorbed and, you see a big reaction, or sometimes you see a reaction over a period of time. And this becomes sort of crucial for us to figure out how a central banker must operate in times of crisis and in good times. So in some sense, sorry for the long intervention, but I feel like you're almost underselling what you're doing by making it a conversation between like the literature of monetary economics. This really matters for every single person, every single checking and savings account, and what is going to be the cost of tomatoes tomorrow in the market, right?
Absolutely. I agree with that point entirely. And particularly so because, if we don't have accurate quantitative estimates of how these interest rates are affecting the economy, and if the central bankers themselves don't have a clear idea about this, then, they may be acting too aggressively or not aggressively enough in response to incoming economic events. And that has very direct, tangible economic implications for everybody who's sort of at the receiving end of that policy, which is in the case that I'm studying, everybody living in India.
Yeah. So how does one even go into thinking about this? Like, what would be a monetary policy surprise versus what would be a scheduled announcement in this world of 24-hour news and tweets and, people monitoring cars going in and out of the RBI? Like, what is a good way to even think about this as a setup?
Right. So I start with scheduled and unscheduled announcements first. So what I mean by a scheduled announcement is any announcement that the RBI makes as a review of monetary policy that is part of its regular cycle of, today we have the Monetary Policy Committee, and the Monetary Policy Committee, we all know much in advance, meets 6 times a year. And the dates are also advertised in advance, and a press conference is convened for this purpose. And regardless of whether the RBI wants to make a change in monetary policy, the MPC will, in this scheduled interval, meet and review the monetary policy environment and decide if anything needs to be done. And if it feels nothing needs to be done, it will just have a press conference saying, we have decided to keep all rates unchanged, which the RBI has done a lot of in the past few years.
Yeah.
Whereas an unscheduled announcement is one which is outside of this regular meeting cycle. Notable examples are there during the COVID-19 pandemic. So if you look at 27th of March 2020, there was an emergency meeting of the Monetary Policy Committee, and there was a sudden change in interest rates, which was completely unanticipated by the market because the RBI felt the need to act in order, to reduce liquidity constraints that the economy is facing as a result of the lockdown.
There are a number of different rates that we usually talk about, right? Like there isn't like one universal interest rate that we talk about.
Right.
So what is perhaps the best measure of looking at surprise announcements? I imagine it's nothing very long term, right? So it's got to be something quick that's easy to measure, that's a quick reaction. So how do you go about constructing the actual measure of how to think about the surprise?
So how I construct the monetary policy surprise is using what is called an overnight index swap contract. Now, I'll explain what this is in more detail, but this is essentially an interest rate swap contract that is linked to what is called the Mumbai Interbank Overnight Rate. Now, the Mumbai Interbank Overnight Rate is an interbank interest rate. It is the interest rate at which banks in India borrow from each other overnight. This also is very closely related to what is called the weighted average call rate, which is another measure of the interbank interest rate that the RBI constructs and maintains. Now, the weighted average call rate, or the MIBOR rate, serves as an operating target for RBI's monetary policy. So the RBI may have at its disposal several tools to set monetary policy. So everyone would have heard of the repo rate, but there are many rates linked to that, like the marginal standing facility rate, the standing deposit facility rate. You have the cash reserve ratio, the statutory liquidity ratio, and the RBI, in various instances, is going to be moving one or more of these interest rates to set monetary policy. But the end goal of all of these actions is to affect the MIBOR, or the weighted average call rate. And so whatever is happening to MIBOR serves as a sort of summary statistic for the RBI's monetary policy. And that is what I utilize to construct the monetary policy surprises. And the way I do that more specifically is that if you look at the overnight index swaps, what they essentially consist of are two legs. So in an interest rate swap, you have two people deciding to swap interest rates. Now, one of those interest rates, because this is a MIBOR OIS, is going to be the MIBOR interest rate that is market determined on a daily basis. But the other leg, which is often called the fixed leg of the OIS rate, is going to be determined by the two parties that are entering into this contract. Now, typically, they enter into this contract for a fixed period of time. And I'll specifically be looking at the 1 month MIBOR OIS, but there are MIBOR OIS rates going up to 12 months duration. And in each of these, when people are setting the fixed leg interest rate for the OIS contract, what they're essentially trying to do is forecast what the path of the MIBOR rate is going to be for the duration of the contract. And then, in order to ensure there is no arbitrage opportunity available, they're going to set an interest rate such that the expected cash flows from investing in MIBOR for that duration exactly equals the cash flows you get from this fixed interest rate on the OIS contract.
So basically, you want to measure the expectations that the people who are closest to the financial system are, setting or interpreting as a result of the policy announcement, right? So this is not how I interpret how my mortgage or my car loan interest rate is going to be. That's really far from the announcement. So the OIS swap is about the closest, and because it's a swap and there's skin in the game, it's probably the best way to measure the signal or the expectations. Is that a good way of thinking about it?
Absolutely. And I would also add to this and say that the people who are usually trading these OIS contracts are banks and financial institutions who want some kind of interest rate protection or protection against fluctuating interest rates. Yeah. And so they sort of take these overnight index swaps that gives them the ability to swap their risky floating interest rate exposure for a fixed income return. Often these participants are much closer and much more closely monitoring what the RBI is doing. And so you can think of these as the expectations of the RBI's future path of monetary policy held by, rather well-informed market participants who have a lot of skin in the game, as you said.
And also because it's the large part of the banking system, it also affects what are going to be the downstream rates following that for regular folks, right? And regular businesses and so on.
Absolutely, yes.
So now that you can measure how to think about a surprise announcement through this very, very specific, OIS overnight index swap, how does one think about the impact through monetary policy, right? So the two things that we typically care about as economists is output and inflation, right? And unemployment gets thrown into the mix from time to time. In India, a little bit less so. So what are the standard and the non-standard measures that you're actually going to look at, let's say immediately and over a longer period of time, to see if the announcement had the actual impact that it intended to have?
Right. In the monetary economics literature, there are economists look at a number of things, both at a very high frequency and at much lower frequencies, to understand how monetary policy transmits through the economy. At a very high frequency, even like within the day, it's possible to look at what the change in interest rates of the central bank is doing to, bond yields of longer maturity government bonds, what it's doing to stock prices and other asset prices. And that gives you a good sense of the extent to which, the interest rate changes are passing through to prices and interest rates that matter for final decision makers in the economy. And a bit further down, it's possible to look at how these interest rate changes affect expectations of both professional forecasters as well as of households, and how they form expectations about how economic conditions are going to be in the future. Now, expectations matter as an economic quantity in themselves, and this is something central banks monitor very closely because people are forward-looking decision makers, and their expectations of what future conditions are going to look like is going to have an impact on how they're going to make their consumption and investment decisions. And that's going to translate into having an impact on GDP and on inflation. And finally, of course, it's possible to trace out what economists call an impulse response function to understand the dynamic response of inflation and of output quite directly in response to these monetary policy surprises. So you could just take your measure of industrial production or some other measure of output. You could take your measure of inflation and regress that, in period zero, and then in period, say, 2 years or 3 years from now, directly on the monetary policy surprise to see to what extent it's affecting the economy. And it's possible to trace out an impulse response function which shows how the effect of the interest rate change is affecting these variables over time. And typically, macroeconomists are very interested in these dynamic responses because that is what they're going to be using to build their macroeconomic models, which central banks increasingly use both for their own internal assessments of how monetary policy affects the economy, but also for forecasting purposes.
So now that you've explained that there are two parts to this, right? So one part is just asset prices, which you're looking at, right?
Yeah.
Which is sort of like an immediate target. And also, there's a lot of classification. And the second part is the, broader macro aggregates, output, inflation, and so on. So if I come back to the asset prices, so the way I think about the mechanism is that if the 1 month OIS fixed rate is higher over, say, the 2-day window, then markets will learn that policy is tighter than they had originally thought. And if it's lower, then they'll think that it's looser than they originally thought, right?
That's right.
So let's say if there's a 1 percentage point, like 100 basis points surprise tightening on a scheduled announcement day, what you find is that it increases the 1-year bond, 5-year bond, and 10-year bond at different levels, right? So the yields for the 1-year bond is roughly 28 basis points. For the 5-year bond is roughly 19 basis points. And the 10-year bond is roughly 16 basis points. Right. And overall, it's going to, lower the equity indices. You find that that's about 3%. And, other effects like exchange rates and other things are relatively small. So when I look at your paper, this to me looks like the immediate asset price reaction, both in the bond market and the equities market, right? Now, within the asset price world, how do you think about whether these are blips, which are also responding to other kinds of information simultaneously, because the time period is so tiny, or whether there are longer term effects for the same asset prices that you're monitoring, for the 2-day window and so on and so forth?
Right. So that's a great question. And my response to that is that it's possible to look at the longer run responses of those same variables by doing impulse response functions, as I had mentioned earlier, where you take the same variable, say, take equity prices, and you look at what equity prices are going to be in response to this interest rate change, 6 months from now, 9 months from now, 12 months from now, and you can plot those impulse response functions. And in particular, in my paper, what I show is that the equity price reactions to monetary policy surprises are starkly different on scheduled announcement dates and on unscheduled announcement dates. In particular, on scheduled announcement dates, you find equity prices declining on impact, which you see in the event studies on the same day. But I also show later on in the paper that if you even do impulse response functions with these equity prices, you will find that these declines are rather persistent. And they last for around 18 months, 24 months after the change in interest rates. So this is not a short-lived reaction. It's something that has persistent effects on these asset prices. Whereas on unscheduled announcement dates, you actually find equity prices going up on impact. And if you look again at the impulse response functions, they tend to remain so for at least some period of time before returning back to their normal levels. Now, one point I wanted to add here for context is that we're trying to measure monetary policy surprises using these interest rate swap contracts. And the essential idea behind identifying these monetary policy surprises is that the change in the fixed rate that we're seeing around the monetary policy event is driven entirely by the monetary policy event and not from information coming from elsewhere. Yeah. Now, of course, one of the major points that I'm trying to make in the paper is that this is much less likely to be the case on unscheduled announcement dates than it is on scheduled announcement dates. Now, how does this connect to the asset price responses? Asset pricing theory tells us that any asset price is really determined by two quantities, one being the future cash flows that the asset is going to provide the holder, and the other is the discount rate at which they're discounting this future cash flow. Now, when interest rates rise, we know that credit conditions are tighter. It's going to be harder to generate cash flows in the future. So we would expect future cash flows to go down. And the discount rate is also rising. And for both these reasons, we'd expect the asset price to fall. Now, to the extent that we don't see it falling, suggests that there is also other information coming out along with the monetary policy announcement on unscheduled announcement dates. And that's what is perhaps driving responses in a theoretically unexpected direction that we are seeing on unscheduled announcement dates. Because, as just to give you an example, if we see on an unscheduled announcement date interest rates going up, say 100 basis points, it could be that interest rates are going up because there is better than expected economic performance, and news about that is getting released at the same time. Given the granularity of the data we're having to work with in India and also in other developing countries, when you're looking at the change in the fixed rate in this 2-day window around the announcement, you're picking up the effect that financial market participants are seeing as a surprise from the central bank's own announcement, but you're also picking up this new information that they're getting at the same time about better than expected economic performance. Now, with better than expected economic performance, they're more likely to revise upwards their expectations of future cash flows, their expectations of how the economy is going to perform. And due to all of these reasons, it's hard, firstly, to get a clean monetary policy surprise on unscheduled announcement dates. And following on from that, it makes it hard to get a reasonable causal effect of the interest rate changes of the Reserve Bank of India on our outcomes of interest by using the surprises that we're getting on unscheduled announcement dates.
No, and also just common sense, right? If it's an unscheduled announcement date, it probably means something happened, right? It could just be good news and things are going well in the economy. More often than not, it's usually they're reacting to some adverse event, if not in India, globally. And everyone else is too. So I think just in terms of common sense, if there's a meeting that's called that's not one of your 6 usual meetings, something happened, and it's no big secret because these are typically big, important global events, or a new report has come out, or Standard & Poor has changed its rating on India. There are so many things that could happen, but it's a little bit naive for people to assume that, central bankers will have all this information and the rest of the market participants will have none, because usually it ends up being the other way around. Yeah. So there's a very commonsensical explanation for why you do what you do, I guess.
Yeah. Well, so there's just 2 points I want to make on this. The first is that, while we see these problems with unscheduled announcement dates are also very useful for an empirical macroeconomist because of the fact that you very rarely get very large changes in interest rates. Yes. Typically on unscheduled announcement dates, you find very large changes in interest rates. And for any econometrician working with macro time series, getting the kind of statistical power that you get on unscheduled announcement dates, it's like a gold mine.
Yeah.
But the point I'm trying to make in the paper
it's noisy.
is that, it's noisy and it comes at a cost of imprecise identification. And so you're facing this trade-off between power and identification when you're deciding to use unscheduled announcement dates. Now, in many contexts, the number of unscheduled announcement dates that you would have in your time series would be very, very tiny. So if you look at the US, for example, in the last 25 or 30 years, there have been much fewer unscheduled announcements than you have in India. In India, there's just a very large number of unscheduled announcements over the 20-year period that I look at between end of 99 and the beginning of 2020. And because of that, the problems of identification associated with using unscheduled announcements are just much greater in India than they are in other contexts, and make it all the more essential to grapple with this trade-off in that context.
Yeah, and this is an important thing to flag. One of the reasons this is so recent in India is that monetary policy as a serious tool for intervention is a relatively recent post-liberalization phenomenon. You have to have really strong, robust markets for monetary policy to actually transmit anything meaningful, which really doesn't quite work in a command and control economy. Yeah. I mean, they can set interest rates all they want, but you're not going to get that dynamism that you can only have in a market economy, which in India starts really only in the 90s. So the fact that we've had only, say, 25 to 35 years of really good monetary policy instruments, and in that we've had only 20 years where we're learning to do how this is done, and now only a few years, less than a decade of the MPC, right? So that just gives you a sense of we're learning this as we go along in some sense.
Yeah, absolutely. And The one other point I'd add is that, in order for monetary policy to work well, you also need fiscal monetary coordination.
Yeah.
And often in India, in the pre-liberalization period, fiscal monetary coordination often meant fiscal dominance of monetary policy.
Yeah.
In that the government could issue debt and the RBI had an obligation to purchase that debt, which essentially meant the RBI had to print money to purchase whatever debt the government was issuing. And one of the implications of having that kind of system is that no participant in financial markets, or for that matter, any economic decision maker, is going to have any confidence that inflation is going to be anchored around a particular level, and that it will be low and stable, regardless of any target that the government announces. And so the really big policy reforms aimed at reducing and completely eliminating, for example, automatic monetization of deficits and providing central bank independence and a target for the central bank to target an inflation rate, have all been steps towards establishing greater credibility in the eyes of market participants and economic decision makers that the government is serious about keeping inflation stable and low. And that has proven beneficial. If you look at the inflation record since the MPC and inflation targeting has come in, inflation is broadly, if you sort of leave out the COVID period, has been at levels that fall within the RBI's mandated inflation target. When the RBI Act was amended in 2016, as part of the Urjit Patel Committee recommendations, the Reserve Bank of India, which at that time was targeting what it called multiple indicators, in that it was trying to keep prices under control, but also ensure a fast rate of economic growth, was suddenly told that your only target is to ensure that consumer price inflation remains between 2% and 6%, with a point target at 4%. So on average, you're trying to maintain 4%, but you have leeway to go above or below plus or minus 2%. And since that was introduced, the inflation performance, if you look at the CPI inflation rates since the introduction of inflation targeting, they've broadly been within that band. There are very few instances of the inflation rate going outside of that band, because the RBI, according to law, is now mandated to write to the government to provide reasons in case it fails to meet that target. And that has firstly helped to anchor inflation expectations. People now take the mandate seriously, and that is half the battle won, because when setting prices are baking in the inflation target rate of inflation, they're going to raise prices by less. And that's half the battle won for the RBI already. And then it also makes all of its other communication and all of its other policy actions much more credible. And in that sense, it's been very successful as an experiment in the recent past.
So, for you, we have a secondary problem in the paper that you encounter, in the sense that the MPC is a relatively recent thing. It really the RBI, as you said, got amended in 2016. So we really have data only after that. So about 9 years worth of data. The most, the link between surprise announcements and asset prices is quite clear and quite tight. But the most important mandate, as you just discussed, is inflation. What is a good way of thinking about these scheduled surprise policy announcements before the MPC and after the MPC got instituted, and how that has impacted inflation? Is there a major break that you see between the two periods? Is it more continuous in the way markets react? Because the underlying mechanism is the same. So what's a good way to think about that?
Well, I agree entirely with you in that the underlying mechanisms are the same. But if you ask me about what is likely to have changed with the introduction of the MPC and the inflation targeting regime, is really about inflation expectations. Prior to the introduction of an inflation target, the RBI was making no systematic effort to anchor inflation expectations, or for that matter, measure inflation expectations. It's only in the recent past that there have been attempts to both measure household level, firm level expectations of inflation, and secondly, sort of try and anchor them around the inflation target. Now, that is very helpful from the standpoint of monetary policy transmission to inflation, because if people are anchored around the inflation target, inflation is just going to be less sticky and fall much more quickly from whatever level it is at to the target level much faster than it does in a world where you don't have any anchoring of inflation expectations. And I do have some evidence in my paper in the appendix on how the response of CPI inflation has sort of changed rather dramatically with the introduction of the Monetary Policy Committee and inflation targeting regimes, with the prices reacting much more immediately and swiftly in response to interest rate changes. So it does have an effect, and I have some evidence to show that it does. But of course, using more recent data would allow us to establish this more clearly.
Yeah, you can do a part 2 of this as we go along in time, right? So, I have a question which is a little bit about how the sausage is made, right? So if you are on all these policy economists and geeky economists WhatsApp groups like I am, then you know that before there is an MPC scheduled meeting, people are like, hey, what do you think is going to happen? All the economists are like chiming in on what they think is going to happen. Yep. Twitter is going crazy. The central bank all over the world is not exactly known for keeping secrets. Like, I wouldn't exactly call them leaks. Like, it's not actual papers getting leaked. But central bankers are talking to people in the markets all the time to get a sense or a pulse of what's going on, right? So how much of all of this is like, in one sense, almost endogenous, right? Like, central bankers know what you're saying, which is, scheduled announcements are understood quite differently from unscheduled announcements. So they already have this information. They know how the markets are going to react. They have a rough sense of the asset price reaction versus the inflation reaction. And so now they themselves adjust what they're going to say. And then the market players know that they're already adjusting what they're going to say based on the reaction. So they react and adjust there. So this is like almost like a crazy dynamic back and forth that keeps going on, right?
Absolutely, yeah.
What is a good way to think about that, given everything else that you've told us?
Right. So one thing I'd say in terms of measuring the monetary policy surprise itself, the way the method I'm using gets around this problem of there potentially being side channels of communication between the central bank and financial markets is simply the fact that, to the extent that such communication exists and to the extent that there is valuable information about monetary policy in that communication, it's going to reflect in the fixed rate getting appropriately adjusted. So market prices are going to reflect not just publicly available information, but also potentially privately available information that they have from the central bank.
That's why you use the OIS, basically, because the swap will tell you everything you need to know in some sense.
Exactly. So that's one thing. But the other point I want to make here is that the responses that I am showing in the paper are responses to these monetary policy surprises. For audience listeners who've heard of the Lucas critique, they will know where I'm going, is that it's very difficult to extrapolate from the responses that we are seeing to the monetary policy surprises to saying how systematic monetary policy will go on to affect the economy. So what do I mean by the Lucas critique? So the Lucas critique, particularly in the context of what I'm saying, is essentially the idea that you simply cannot extrapolate to look at the effects of a particular policy in a counterfactual sense if it's different from the policy that you're implementing. So just to give you an example, if I'm providing you with estimates for how the economy responds to 100 basis point change in monetary policy under an inflation targeting regime, tomorrow, if I were to make an assessment of how the economy is going to react to 100 basis point change in monetary policy, when I have a regime in which there's automatic monetization of government deficits, I simply cannot use the same number because I need to take into account the fact that everybody in the market is going to update their expectations about how inflation is going to evolve in the future because there has been this change in fiscal monetary coordination. And it's essentially, therefore, the idea that you cannot really say anything about counterfactuals without first building in a model that has agents who are also taking into account the changed rules of the game in that counterfactual world that you're looking at. And that is typically what macroeconomists do with these kind of estimates that I'm generating, in that they will try and write a macroeconomic model, what's often called a dynamic stochastic general equilibrium model, where you would have households, firms, you'd have the central bank also as an agent, as a part of that model. And they will then specify all of these agents with expectations about how the economy will evolve. And these expectations will, of course, be the actual expectations that are driving random processes inside the DSGE model. And then they will try and use that model to match the estimates that we're seeing in the data, and then use that calibrated version of the DSGE model to make other counterfactual assessments about how policy will evolve under different circumstances. Yeah, so connecting that back to my paper, what I essentially wanted to say was that these are responses to monetary policy surprises. And in order for this to be sort of useful for a policy audience, the direct connection comes from integrating this with a DSG model that, say, the RBI itself has been using in the recent past, updating the parameters that they're using to calibrate that model and get a better assessment of how their own policy is operating in the economy, and also get better forecasts for how the economy is going to evolve in response to the various actions that they are taking. And that's how modern macroeconomists make use of these causally identified moments in the data.
Yeah. So, if I had to ask you, so what is the policy implication of all of this? So, very directly, when I think about it, your paper is really telling us about measurement and how we think about measuring monetary transmission, right? Now, let's say I were a central banker. Now, what is the message that I should take away? Is it that I shouldn't have unscheduled policy announcements? That seems crazy, because the whole point of having a monetary policy lever is that you can actually use it when things are really good or really bad. That is when you need to temper things in an exuberant market, or you need to actually propel things, because of an adverse global event. So what is it we can really take away from your paper in a more pragmatic, playbook manual sort of sense?
One thing I'd say here is that, and this is something to the RBI's credit, it has already internalized in its decision-making procedures, is the fact that there is great value to reviewing monetary policy very frequently.
Yeah.
And if you look at the RBI's own 20-year history on this, in the early 2000s, the RBI was conducting monetary policy scheduled reviews twice a year, before two planting cycles that were there in India at that time and continue to be so. But then it was much more agrarian economy than it is today. And so the agricultural cycle was sort of formed the basis for when the RBI was reviewing policy. But as India's economy has, industrialized, opened up, and become much more globally integrated, global events have much more immediate implications for India's economy. And as sort of price controls have gone, shocks are going to sort of start reflecting on people's wallets much more quickly. All of this means that it's much more essential to act quickly, and therefore to be on the lookout for events that threaten macroeconomic and financial stability. And the best way to do that is to have regular scheduled reviews of monetary policy. And at least since 2016, the RBI has been doing a review every other month, much in line with what is happening in the rest of the world. So for the econometrician, that's very helpful, because firstly, it eliminates a lot of the unscheduled announcements, because when you have very frequent scheduled meetings, there is less of a need to act outside of that schedule. But it's also beneficial from a macro and financial stability standpoint, because the central bank, firstly, is communicating at regular intervals, and is also putting together the institutional resources to review monetary policy at regular intervals, both of which are very helpful. Because even if the central bank were acting outside of schedule to deal with immediate developments, it's always much better to make these decisions once you had a team of economists put together an economic policy report to analyze the economy and have deliberations before making that decision, rather than acting in haste when something erupts. And so for both those reasons, I'd say the major policy lesson, I would say at some level, has already been learned in many countries, is that you should review policy very frequently. And an important ingredient to that is having a statistical system in place that gives you sufficiently high frequency information about the economy. That is a prerequisite for having these regular scheduled meetings at, say, a monthly or a bi-monthly frequency, is that you need to have new information to process at each of these meetings. So setting up that statistical infrastructure is also an equally important component of this.
And as more Indians get plugged into the banking system, as more transactions become more and more formal, right? As opposed to what was in the underground economy in India during command and control systems, the better data we're going to have. And then these data can also be sliced and diced in more granular ways to actually tell us what is it that, a central bank or anyone else is measuring. So this was really fun to read. Fun is a weird word to use for this paper. I actually learned a lot because it's such a detailed model and I don't encounter this stuff frequently. But it was like super fun to actually read this paper because we're living through this in India as we go along, right?
Absolutely. And I think that getting the macro and financial stability right is very essential for any growing economy because no investor is going to want to come in and invest in an economy where, the underlying institutional features, sort of the institutional plumbing that's keeping both the economy and the financial system going, if they aren't being handled well, people will think twice before investing. And so this is the most robust foundation that's necessary in order to sustain economic growth at, say, double-digit levels for a sustained period of time.
Which is the hope.
Yeah.
One last question before I let you go. What else are you working on? Can you tell us something about some of your other papers or your other research interests?
I'm very interested in monetary policy and in particular how it works in India. So in one of my other papers, and this is co-authored with Vimal Balasubramaniam at Queen Mary University of London, I look precisely at the point you made earlier about what role growing financial inclusion has in sustaining monetary policy transmission. So what happens to the transmission of monetary policy to household income and household consumption as these households get plugged into the banking system? Because as you get plugged into the banking system, firstly, you become much more sensitive to interest rates because your fixed deposits are going to change in terms of the interest rates on those deposits are going to change when central banks change their policy rates. If you've taken a mortgage or if you've taken a loan, the EMIs you're going to pay on that are going to react much more quickly. They're going to react in response to these interest rate changes. And therefore, you're going to be affected much more immediately in response to any interest rate change. And so in that paper, we try to understand this in more detail by putting together these monetary policy surprises with administrative data on financial access in India and household survey data on consumption and income. So that's one other paper I have related to this that is work in progress. There's another piece of work I have, again, work in progress, co-authored with Amit Lagdawala and Rajeshwari Sengupta, which looks at central bank speeches and the information that they may contain and how they transmit through the economy as well. So these are a couple of other projects related to this that I'm working on at the moment.
Yeah, no, that sounds fascinating. The central bank speeches especially, because people, the entire financial press will show up. We're all looking at it, reading every word and every eyebrow movement with hawk eye attention. But this sounds fascinating. Thank you so much for doing this, Karthik. This was such a pleasure.
But it was a great pleasure for me to be on the show as well. Thank you very much for taking the time to read through my work as well as to engage with it so thoughtfully. Thank you.
And we hope you come back.
Well, I hope to be back also. Thank you very much.
Ideas of India is produced by the Mercatus Center at George Mason University. If you enjoy this podcast, please subscribe on Apple Podcasts, Spotify, or your favorite podcast app. Help us grow by giving us a rating and leaving a review. Follow us on Twitter at @SRajagopalan and at Ideas of India. Also check out our initiative commemorating 30 years of India's market reforms at the 1991project.com.